2021. Question 8, subsection 2. What is the difference between net exports and the current account balance in the BOP? So what is net exports, Lamai? Net exports is the value of exports minus your value of imports. It includes both the goods and services, exports and imports. So you need to explain what is net export. That is your goods account balance and service account balance, exports and imports of all of them. Then what is your current account balance? That is a much more broader concept which also includes your net export. In addition to having your goods and service account balance, it also includes primary income and secondary income. You can write nothing there, Lamai. So for 2 marks, talk about what is net exports, goods, services. You can talk for 2 marks. Say that, look here, current account balance is much broader than this. It includes this also. In addition to this, there is also something called primary income. Primary income has things like rent, wages, interest, profit. Secondary income has all the current transfers, mainly things like worker remittances. You can include. So goods account has, you can say, tangible goods. Services account has the import and export of services like financial services, tourism. Goods, you can say, in Sri Lanka, things like tea, rubber, things like garments. You can give some examples and you can expect a very simple question that you can get. Then part 3, outline 4 main factors that cause the demand and supply curves to shift in the foreign exchange market. Now, tell me, what factors affect the demand and supply of a currency in the foreign exchange market? Okay, yes, definitely international trade. That is number 1. So international trade will include what, Lamai? So you have to outline. So outline means you have to give a small, brief 1 to 2 line explanation. So international trade, you can say, what is it? Will include your exports and imports. So the exports and imports of a country will affect the demand and supply of a current. Okay, so you can talk about that. Anything else? International trade is the main thing. That has to ideally be your number 1 point. Anything else? What else can you give? You can give, Lamai. What about, okay, you can talk about price level. So changes in, let's say, price level. So remember, we learned if in your country, if the inflation is high, yeah, you can say change. So you can say the imports and exports of a country, changes in the price level. Remember, in your country, if price levels go up, then what happens? In your country, prices go up, your exports become uncompetitive. Demand for your currency will come down. So you can talk about those. Anything else? So you can talk about foreign investment. So there can be investment inflows and outflows. Foreign investment, that's definitely something you can talk about. So foreign direct investments, portfolio investments, things like those. So that's another thing. Separately outline for demand and supply. No, you don't have to go to separately for demand and supply. You can in general talk about 4 points. So they're saying outline 4 factors that cause demand and supply curves to shift. So you don't have to separately talk about demand, so we talk about supply. No, it's the same factor. No? You can talk about in general. Anything else? Savings, how? Not directly though, but even interest rates, changes in interest rates in a country. If interest rates increase, foreign investments increase. If interest rates increase, more and more people will come and invest in Sri Lanka. Let's say sovereign bonds and all. Let's say if Sri Lanka is giving 20% for international sovereign bond, so many people will come and invest in Sri Lanka. So that will increase the demand for the rupee and cause appreciation. If the interest rates go down, people will take their money and go out. So changes in interest rate. Then you can also talk about loans, Lamai. Loans and repayments of those. So all of these are factors. There will be more. You can go and see. So any monetary inflow or outflow, Lamai, is speculation. Any monetary inflow or outflow will ideally affect the demand and supply of the currency. So that is that part. Okay. So outline means, Lama, you have to give like a small 1 to 2 line explanation. Okay, don't just state like I have stated. Give a small 1 to 2 line explanation in your own words. Then number 4. Ex-government intervention fund. What is the role of the central bank in the following exchange rate system? So what is the role of a central bank in a fixed exchange rate system? What do they do, Lama? So you have 3 marks. What can you write? What is the role of the central bank in a fixed exchange rate system? So what do they do, Lama, in a fixed exchange rate system? So in a fixed exchange rate system, the exchange rate is kept fixed at a certain level. And then what happens? What happens? So start off your answer by saying the exchange rate will be fixed. And then how do they maintain it at that level? That's what you have to explain here. Role of the central bank. So if the exchange is, if there is pressure for it to devalue, what would they do? If there is pressure for it to devalue or depreciate, value to go down, in other words, the value will go down if there is like a excess supply of the rupee or there is an excess demand for the dollar. So if there is an excess demand for the dollar, now when do you demand dollar? You demand the dollar when you have to when you have to pay, no? So if there is like a huge demand for the dollar and the currency is going to depreciate, then what will they do? Then they will create an artificial supply. They will create an artificial supply. So if the currency is going to, let's say, appreciate or getting revalued to a higher rate, maybe the reason is because the supply of the dollar is high. Then they would buy back. They would not create a purchase. They would buy dollars. In other words, they would demand for dollars. So that, guys, I'm hoping you all know the basic theory path there, okay? How they, when the exchange rate is going to depreciate, what they do, when it's going to appreciate, what they do. So that story is what you have to write in your own words. It's kept at a fixed level, but they will use their reserves to manipulate the exchange rate. Then, second one, they're asking for a managed float. Managed floating also same thing, Lamai. There is nothing different. It's just that you have to say that they will allow it to float to a certain level. So within a certain range, they will allow to float. Central bank will not intervene within a certain range. So within a certain range, if the exchange rate is appreciating, depreciating, they won't intervene. But then again, if it tries to go above or below that range, then they will intervene and they'll do the same thing. If it's going to depreciate, they will supply the dollar. If it's going to appreciate, they will demand for the dollar. They will do that. That is, if there is a managed floating. But clearly highlight that initially they will allow it to float freely, but after that they can create artificial demands and supply by buying and selling the currency. So go through that. Done. Then yeah, that's it with 2021. I think that was an interesting paper. They had 3 questions. Good one.